Back to the major indexes. Again, stocks ending near their session lows. The Nasdaq booking a loss of worse than 4% and now down about 30% from its own high back in November. Concerns that more downside is ahead. Joining me now is David Struzeski, CEO of Sound Planning Group. David, thanks so much. What do you make of today's market action?
Well, my goodness, we picked one to talk about, didn't we? So here's where we are right now. 2022, we're at the end of what has been the longest bull market that the world has ever witnessed. The Federal Reserve has been a big player in getting to this place, and now we've been reducing interest rates meaningfully since September 1981, 40 years, and now we're having to raise them. So the market's not happy about the raise. At least it was telegraphed, and we weren't surprised by it. They've told us that they're not going to crash the market with their raises. So my expectation is that they're not going to do more than what they're saying. The question is, will they actually get that perfect, splash landing? Because here's the challenge with the Fed right now. The Fed, if they raise rates enough to actually deal with the inflation crisis and cool down the market, which means actually, slowing down what we can purchase. That's what's needed to happen here is that we as consumers need to slow down our purchasing in order for inflation to settle down. But if they raise rates so much, well, guess what they do? They kill business. And right now, what we're seeing is a challenge here with liquidity. So we've got low liquidity right now. We're used to refinancing our debt, all the time here as major corporations. And so a lot of deals that we're even getting put together, we're coming in with billions of debt from each company. Those deals may not make sense any longer. And so as our economy is beginning to move and change here with some of the Fed's adjustments that they need to make, well, now we're seeing interest rates rise. And that specifically is going to have a... Yeah, please.
Clearly higher rates, I think, David, the main factor here driving the market lower, even though there are still so many unknowns out there as well. China, the coronavirus, Russia's ongoing invasion of Ukraine. But certainly Wall Street is increasingly volatile. And we all knew volatility was going to be a key theme this year, but so much so picking up that there is starting to be real concern that we could fall even further from here. Is that your expectation?
So let's just say that the low liquidity right now in this very volatile environment doesn't make for a great story to say that there should be this wonderful rebound coming out of this like we saw in March. I think that we're looking at this a little bit different. So I'm personally cautiously optimistic. The market has surprised us. It's possible the Fed can pull this out. People settle down. They'll recognize these are world-class companies. Nothing changed with them. But, recessions are normal and they're healthy, frankly. Pruning is healthy. Am I expecting downside? Yes, I am. And we've been preparing for this for a long time. So there's a bond bubble in bonds. There's a stock bubble. And there's also a real estate bubble happening right now. As interest rates rise, the value of real estate is going to have to come down relative to the median income, or what 1/3 of someone's buying power can afford. And so we're finding ourselves sort of in this interesting dichotomy where all these things are converging all at one time. And so, yeah, that makes for a very tumultuous moment. I'm sort of dubbing this the Federal Reserve bubble, and we'll see how it plays out and how they can kind of navigate their way through this. But I think they're late to the party. And unfortunately, that means that our CPI is going to be going crazy. And I know that's like your next point in talking about here is we're looking at the CPI numbers here this next week. And here's what I'm going to share. That's super important for us to understand. But why don't we actually look at our own personal CPI numbers? So we've had this high inflation now since 2021. This didn't just begin with the Russian-Ukraine situation. This has been now for over a year. So we have 1 year of data to be able to look at our personal expenses to understand where we may be seeing inflation higher. So I think good advice for average people is make sure that you're looking at your budget and you're looking at your day-to-day, because we're in a storm. We're going to have to ride through some things.
Are there any signs, David, that you see inflation is starting to peak? Of course, many said the Fed was too late to act, that it continued to call inflation transitory into the fall. And many people, anyone shopping, right, doing daily shopping at the grocery store or elsewhere, taking an Uber or a Lyft, I clearly knew that this did not seem like a transitory environment. But now there are some calls that inflation is starting to peak. Do you agree with that?
So it's going to come down to supply chain. I just bought a car here 2 weeks ago. pretty amazing. I bought a used car for more than MSRP. It's, incredible. But there's this significant supply chain shortage, as well as a lot of disruption taking place in semiconductors that I'm very concerned about right now. And so, do we think that inflation's over? I don't think so. I think that we're going to see it in oil. I think we're going to see it in some of the building materials. We're going to have challenges in getting the supply chain completely together. Like, think of a Ford truck, and that it might take 50 different, shipments of things coming together in order to make, one truck. And so if we have challenge with two of those things, guess what? That's not all 50. And so we're going to have to figure out how to work through this, and we're going to have to figure out some different innovations in order to maybe sell cars.
David, in this market, is there anywhere to hide? I mean, everything across the board, right, is lower. But are there moves that you're recommending to your client base that they make that can be advantageous in a market like this?
Absolutely. So right now we are in the middle of this really tumultuous time. So it's very important for people to evaluate their risk. Now, the challenge, of course, is that our risk-off assets like bonds actually could be the biggest time bomb that you could be sitting on right now if rates continue to go up, like the Fed has said. So where do we go and what do we do? Yes, we are going to need to look into some alternatives. They tend to have lower liquidity. And this is why you need to have a balance of liquidity, protection, and growth, the right and most appropriate balance based upon your age, time frame, when you need to be getting money, how much money you need to be withdrawing. The good news is interest rates are coming up. They're just not matching what inflation is. So it's a guaranteed loss. And so you can either be managing money for risk off and trying to avoid crashes, or you could be managing for inflation. They are actually opposite investment strategies. So it's a little bit tricky right now for the average person to be navigating and doing this. This is why they need to sit down and take a math and science approach to their entire situation and understand the preponderance of evidence before they can really make those decisions with clear objectives.
All right, David Struzeski, CEO of Sound Planning Group. David, thanks so much on what's been a complete sellout in the market today.